Fed decision day in America. In your view, what does getting policy right look like?
I don't know if there's a right answer here. Internally at Apollo, we do not think there's a need for a cut. There's nothing in the data that tells us, but at the same time, I understand the decision. But longer term, I'm not sure it really matters. I mean, if you think about what's happening, the market is ultimately determining the outcome. We have governments around the world who are borrowing record amounts of money. We are, for maybe good and valid reasons, fractionalizing our labor supply through immigration reform. We're fractionalizing our flow of goods through the other tariff and other measures, again, for good and valid reasons. Those things tend to be inflationary. And so a lot of what we're doing is inflationary. Certainly borrowing lots of money has the potential to be inflationary. Depreciating our currency has the tendency to be inflationary. And what we're seeing is a steepening of the yield curve. Rates that matter, the 10-year, are higher, even if short rates are lower.
What do you think the impact will be if we do in fact get another rate cut, and if the Fed does embark on maybe one more next year?
I'm not. This is what's priced into the curve. I think at the end of the day, the short-term fluctuations of monetary policy, interesting but not all that relevant. It's ultimately about maintaining the confidence of the financial system and of the bond market, given the scale of borrowing that we and other Western governments need to do.
It's interesting to hear you say that we don't need another rate cut. Apollo, of course, has access to so many. You own so many amazing businesses all around the world. What are you seeing in terms of the economy? Because GDP has slowed, jobs have slowed. So I think the market wants a rate cut.
Slowed from what?
Yeah.
What's normal? We've gone from a period of time of COVID to massive stimulus to tariff shock. Tell me again what's normal? I don't know that we see normal.
Like 2.5% maybe?
Things feel pretty good. And by the way, growth has been in that range, if not higher, from various points in time. Unemployment is at numbers that historically we used to call full employment. We also have mixed signals. We don't have as many workers, we therefore may not have as many jobs. It appears to me in our companies that things are just fine.
I really enjoyed an op-ed you wrote recently on private markets. You've been beating the drum on this. You gave a really good presentation at Goldman Sachs today on this. What are some things that people are not understanding about private markets here?
Well, I think there are two big things that I've really focused on. First, the definition of private credit. In much of the financial press, private credit means levered lending, a below investment grade deal-related activity. And the reality is most private credit is investment grade. And most of the credit in the financial system that is private, banks, insurers, pension funds, is investment grade. There's a whole discussion about what private investment grade is and why it exists, but its competition is public investment grade. And generally, it has outperformed public investment grade, both in return and in safety. Put that to the side. Much of the press is focused, as I said, on this notion of levered lending. The levered lending, a below investment grade activity, comes in two flavors. One flavor is the broadly syndicated type, which is typically underwritten by banks and then distributed. The other is that which is underwritten by asset managers and is typically held and is sometimes called direct lending. The big miss there is it's just an investment. It's like a stock or a bond. We don't think anything of NVIDIA or the S&P going up or down 10 or 15%. And yet, one private credit loan or one broadly syndicated loan defaults and people lose their mind. Why are people investing in levered lending? They're investing to reduce risk. Generally, what investors are doing is they're taking money out of equity or out of high yield bonds and moving into levered lending. It's roughly the same return, and it is less volatile. And if you hate levered lending, you're really going to hate high yield. And if you hate levered lending, you're really going to hate equity. This is a de-risking activity, and it is mostly conducted by investors who are seeking to de-risk. And I just leave it there. We could go on all day and just talk about private credit.
When we saw some of those, the pressures from Tricolor and First Brands, why do you think that really didn't spill over into the broader stock market? We saw some convulsions, but it wasn't like that worrisome moment.
Why should it be? Companies default all the time. I mean, there's in some of the materials that we will put out later today, you'll see 20 years of defaults in the investment grade market, the levered lending market, And the high yield market, well underwritten credit, even if it defaults, usually has very strong recoveries. The notion that something defaulted, okay, it defaults. The question is, was it a sign of something wrong in the economy? The answer from my point of view is no. This was just sloppy underwriting. In both those instances, the warning signs were there. It was avoidable. And by the way, both were underwritten in the banking system in the form of broadly syndicated loans. Forget that that was not direct lending or asset manager driven direct lending. That was a factoid that people just didn't need.
I love this quote by you at the Goldman today. Great fortunes will be made and lost in data centers. Explain that to us.
Well, we were talking about the notion of financing for data centers. And the point I was making is that as a credit investor, you want to get paid back before you get to renewal. Because it is very clear today and for the next few years that the demand for data is unbelievably strong. Therefore, for the next period of time, based on contracts going in today, we should have very safe cash flows in which to amortize credit. Ultimately, the return on equity, though, is a function of renewal. I have a chart on the wall in my office, which is just about energy usage in the year 2030, not that far away. And each of the good and the great consulting firms have weighed in, and it looks like a child's scattered dart plot. The fact is, if experts looking out not all that far have no idea, we are making a fundamental bet on equity. And that bet is driven by technology, it's driven by chipsets, it's driven by energy usage, it's driven by quantum computing, and a whole host of factors that we are not yet considering. So I think as equity, people should be allowed to take that bet. Great fortunes will be made, great fortunes may be lost. We, in fact, are investors in data center equity under the right circumstances, in the right way, for the reasons that we believe we will get upside. But I don't think it is a foregone conclusion that because you own a data center and you own equity in it, and data is valuable, that you will make money in data center equity.
I didn't want to be that guy to ask you about a bubble. So I'm going to ask it a different way. Are you concerned by how much debt some of these tech companies are taking to fund their AI ambitions?
I'd say concerned, I don't know. And I think tech companies is a broad term. For the most part, the hyperscalers are the largest and most successful companies that exist, not just in the US and worldwide. They have massive amounts of cash flow coming from lots of other businesses. And if I am worried about the debt of hyperscalers, the economy and the US have way bigger issues. So generally, I am not worried. But there's a whole series of intermediaries who are large owners of data capacity, who themselves are not in other businesses that afford them the luxury of using their credit rating and balance sheet to make massive commitments. And those companies essentially are the equity owners of data centers. Levering those companies, given my previous comments, does not seem to be the safest thing I've ever seen.
We'll have to leave it there. No new toys. Is that still the mantra?
Oh, that's old news.
That's old news? Okay.
Our business, in fact, our industry has been going through just massive amounts of change. We've gone from a business that historically had one market, the alts bucket of institutional clients, to now 6 markets. What is needed to serve those 6 markets is different than what was needed to serve just the one. And so we and our peer set are evolving our businesses based on how we each individually see the market developing, and we don't all see it the same way, which is what makes it fun.
I would start this getting your reaction on why the markets are ripping higher, the Fed cut rates. But I'm listening to the Fed chair, Torsten. I came away thinking this is the first meeting where the Fed chair is worried about the impact to the labor market because of the AI expansion in the US and around the world. Is AI about to, I guess, just put a bowling ball through the labor market next year?
Well, he was asked that question by a number of the reporters, and this continues to be a very, very important issue because we just don't know quite yet how AI is going to impact the economy. We all know from our daily lives, AI is certainly helpful through large language models. That does increase productivity and how we do things, including here at Apollo, but it still is the case from a macro perspective that we just have to wait a little bit longer before we actually understand Is it going to create an increase in the unemployment rate? Because we're just not seeing that yet. Jay Powell also highlighted jobless claims have been very low. The unemployment rate has gone up a little bit, but it's not the case that we're seeing dramatic productivity increases. It's not the case that we're seeing a dramatic increase in the unemployment rate. So we still have to stay tuned a little while longer while we wait to see what the impact is of AI on the broader economy.
But a good number of jobs, and you heard, I think, the Fed chair hint at this, a good number of jobs could just completely vanish.
Yeah, there are a number of occupations, of course, that are vulnerable. Of course, telemarketers have often been mentioned. There's a number of things when we go down and buy our Big Mac at McDonald's, you now buy that on a screen instead of buying it with a human being. So there's a number of ways that this is being implemented that will absolutely create some very significant productivity gains, especially for some companies that are able to implement and do this in the right way. But at the macro level, and in particular from a Fed view, we just don't know quite yet what's going to happen, especially here in 2026, because we just don't know what the implementation degree and the adoption rate will be as we look ahead. It's all looking very positive, but at this point, it still remains highly uncertain what the impact is going to be on the economy.
Torsten, I know Josh back in the studio had a couple questions for you too.
Yeah, Torsten, I wanted to talk to you about this issue of affordability, this issue of economic anxiety, Torsten, that clearly a lot of Americans feel. It has become politically very sensitive. You see President Trump zeroed in on it now. Greg Ip had this piece in the Journal, Torsten, recently, and Greg kind of suggested, when we talk about affordability, it's almost a state of mind as it is anything else. I'm interested as an economist, Torsten. How do you think about the issue of affordability? How do you define it? Are we, do you think, in some type of affordability crisis? And what is the Fed's role here, Torsten, in tackling that?
Yeah, this is a really important question, because if you think about the basket of goods that we're all consuming, it is absolutely the case that the price of education has increased in the last decade, the price of healthcare has increased, the price of housing has increased. And if you add these three components together, you do get that they make up a bigger share of our consumer spending. So that's another way of saying, if I need to spend more money on healthcare, on housing, on education, well, that means that there's less money left to go on vacation, to eat at restaurants, to buy a new car. So that's why, from a simple CPI or consumption basket perspective, it is absolutely the case that there is just more money going now to the basic needs such as healthcare and housing that we just didn't have to the same degree earlier. To your question about what the Federal Reserve can do about this is a really difficult problem to solve, because essentially it's saying that some of the things that we are buying have just gotten more expensive. And if something has gone up in price, how does the Federal Reserve lower the price of those specific goods? That's just really difficult. There's actually not much they can do about that. Take, for example, one of them in housing. If you begin to see the Fed lower interest rates, that's probably going to increase home prices even more. So in that sense, the Fed doesn't really have any tools to solve the affordability crisis. So from that perspective, it remains a real challenge, as Jay Powell was also asked about here in the press conference, for them to really solve this problem that we're all talking about so much every day.
So let me ask you, Torsten, if the Fed doesn't have the tools, who does have the tools? Is it the president? Is it Congress, lawmakers?
Yeah, it is fiscal policy, and therefore, of course, also very importantly, Congress, because Congress could begin to do things to potentially cut prices in different ways, for example, of goods and food. This is exactly what the president has been doing. That's also what Congress has been moving in the direction of, saying maybe we should roll back some of the tariffs, especially on food, because this has, of course, turned out to be a very important area where we have seen some inflation. So, for example, tariffs could be lowered, which would then have the impact of lowering prices of food. You could also see other initiatives that could actually also have an impact on the housing market, where housing will become cheaper. For example, it could be that you could give some different subsidies or different tax incentives for households that then would have it a more easy time to enter in the housing market. For example, first-time home buyers, as also was discussed in the press conference, now the median age is about 40 years old. Well, if you now then try to lower home prices, not so much by lowering interest rates, but simply by giving tax subsidies to those who want to buy a home, then you could say, well, we're going to give $5,000 or $10,000, or it could be more or less, to those who want to buy a house. That could also be one way to help affordability. So the bottom line to your question is that there are things that could be done, but most of those things are absolutely on the fiscal side, meaning exactly to your point here. The question is, namely, Is Congress going to do something on that? And will we see that? And that's, of course, where some of the action could be coming in order to get some things done in terms of affordability.
Torsten, we've got now a series of rate cuts from the Federal Reserve. We were just talking about AI driving more productivity, and I love what you have written recently, saying that we could have an inflation mountain. Are we looking at an inflation mountain? Rate cuts, AI productivity, and if so, where are we at in that mountain?
No, you're right, because we went through the first mountain was, of course, after COVID, where inflation went up to almost 10%, and now it's come down again to around 3%. The risk is that there's another mountain, because exactly as we're discussing here, you could have growth coming partly because of AI. There's also the One Big Beautiful Bill. The Congressional Budget Office estimates that the One Big Beautiful Bill, because one of the important laws in the One Big Beautiful Bill is that you could do immediate expensing of your capital expenditures if you're a company. In other words, if we had a company, we wanted to build a new building or a factory, we could write that down 100% immediately and deduct that from our taxes. Normally you have to do that over several years. If that's the case, you should expect to see a boom coming in the economy, especially when it comes to capex, not only in data centers, but also in business spending outside of data centers. So there are some tailwinds that argue for the risk that there could be another mountain in inflation coming along simply because of the economy picking up in 2026.
Love this topic. Is that why we're seeing the market rally? I'm not going to say skyrocket, but we're seeing a strong rally off of this rate cut because the market is sniffing out. We are in the late stages of some form of economic boom, and that's going to send more people into Mag 7 stocks. And then, are we in the middle of a bubble?
I do think that very importantly, the narrative and what you and I have talked about through most of this year is that we had, of course, on Liberation Day, that the trade war came along. That was clearly expected to slow things down, and it did slow things down in a certain way. Not as much as many people expected, but we did begin to see a slowdown. But now that negative story, the baton is being handed to a much more bullish story for the economy and therefore also for the market going into next year, where, again, fiscal policy, the One Big Beautiful Bill is helpful, the data center build out is helpful. Given where stock prices are trading, high-end consumers, which was also discussed in the press conference, continue to still do well. All those things are building up to now for a narrative where we have been worried about a slowdown in growth to now more of an acceleration in growth. So we're really beginning to see the U-shaped or the Nike swoosh shaped here at the bottom of that begin to appear here in the near term. And as we get in particular to the second half of next year, we should begin to see things begin to accelerate. So in that sense, yes, both the worries about inflation going higher, but also tailwinds to growth and therefore also tailwinds to corporate earnings should begin to pick up as we get into 2026.
I wake up at the crack of dawn, I think it was a week ago, I get an email from you, 5 risks for 2026. And I love this list. I'm a big fan of lists, especially the ones that you always put out. But this one caught my attention. The new Fed chair lowers interest rates purely for political reasons. What is the risk to the economy from that? And what is the risk to the average investor from a move like that?
Well, one thing that's very important in financial markets is what's been going on in interest rates. We have seen, of course, the Fed has been signaling rate cuts. We just got a rate cut here. So that means that short rates have been going down. But despite that short rates have gone down since the Fed began cutting in September 2024, long-term interest rates have not gone down. So that's why this issue of when Jay Powell steps down in May of 2026, he was just asked about that. Will you stay on the committee? He again said...
Shocker, he didn't say anything.
He didn't say anything.
Yeah,
Nothing new to report on that, as
right,
he said.
Keep it moving.
But the key issue is if the new Fed chair comes in and does begin to lower interest rates and push in that direction, we would have an even steeper yield curve, because that is basically saying short-term interest rates will be lower, and we should begin to worry about that inflation might be even higher than what we thought just a few months ago. And adding to that also additional fiscal problems, the answer to your question is that who the new Fed chair will be becomes very important, because that Fed chair will need to decide how much weight do they want to put on inflation being high and how much weight do they want to put on the weaker labor market. That is really, do you like apples and oranges? Because on the one hand, inflation high says that the Fed should keep rates high and maybe even be hiking. On the other hand, a weaker labor market says that the Fed should be cutting. So that's why it becomes really a difficult balance for them to figure out what will the new Fed chair do. And if the new Fed chair says, I'm going to ignore inflation, that's when we in markets, and especially in the equity market, should begin to worry about that maybe there is indeed a higher risk of this second inflation mountain coming next year, simply because of the Fed chair beginning to put more weight on the growth slowdown than on the upside risk to inflation.
For as long as you and I have known each other, we've always, when we talk about the Federal Reserve, we never really talked about it being politicized. But now that could in fact happen for next year. As an economist, how concerned are you that every Federal Reserve meeting could have some form of politics attached to it?
Well, the issue is we're already seeing with this meeting we had today 3 dissents. 2 dissents saying that we should be cutting, should not be cutting rates, and 1 dissent saying we should be cutting more. The fact that we're having dissents in either direction is already telling you that the movements are more now moving in opposite directions. Some people saying we should have more cuts, and others saying we should not have cuts. So we are beginning to enter now 2026, where we will, at the next few meetings, I totally agree with what you're saying, begin to see more evidence of just more disagreement. And maybe that's healthy, that there is disagreement. You could look at this as democratic debate. But if the disagreement becomes so wide that out of the 12 voting members, let's say that they vote 7-5, that they did cut rates or they didn't cut rates, you and I would call each other and say, wow, that's really unusual, because we have not seen that for a long time. So in that sense, we are entering uncharted territories here where we might begin to see much more disagreement. And the question is how equities are going to trade on the back of that if we do not have the clear, strong messaging from the Federal Reserve that we all have been used to.
Private credit is a $40 trillion market. What happens in this market most certainly has implications for the broader stock market. Can't ignore this market. It's also perceived as risky, despite a good chunk of the market being investment grade. This especially top of mind recently when JP Morgan CEO Jamie Dimon said, when you see one cockroach, there's probably more after the Tricolor and First Brands bankruptcies. But according to our next guest, it's an area of the market that deserves more attention. I'm joined by John Cortese, Apollo's co-head of corporate credit. Good to see you right next to the coffee bar, beehive of activity.
This is where it's happening. Thanks,
this is where it's happening. Thanks for kicking us off here. So before we get into the private credit market, and maybe it probably dovetails, this is Federal Reserve Day, decision day in America. How does this impact what you do from day to day?
It's funny, I was looking at the range of estimates for Fed cuts over the next year, and is it going to be 1 cut or is it going to be 2 cuts? It's amazing how a year and a half ago, 2 years ago, this was where you wanted to really focus your attention, and even we were spending a lot of time on it. For us, the bigger debate is, and this is out there publicly, is U.S. investment grade issuance in the public market going to be 1.6 trillion or 2.2 trillion? How about the private IG issuance out there? These are huge differentiations of potential CapEx spending and credit lending potential for the next few years. And that's really where the big conversation is for us, and I think that's going to drive broader markets.
Not to preempt Fed Chair Jerome Powell, I'm going to assume we're going to get that rate cut. That's what they're going to do
Market's
later on.
saying 90%.
Right, so we get that. How does that change the outlook for private markets and private credit next year?
Well, take 2 years ago, 2023, Apple issued a long-dated investment grade bond below Fed funds rate, because the curve was inverted.
I remember that.
And 10s, 30s were so flat. So it was like 4.85% versus 5% Fed funds. Now these same very high quality issuers, maybe people think of them as quasi-sovereign issuers, are issuing at 150 to 200 basis points above Fed fund rates, because not only is the Treasury curve steepened, but also there's so much issuance out the curve. And for us, that's incredibly exciting. As long duration, high quality lenders in the marketplace, I think that sets a kind of floor for spreads out the curve. And that's really our sweet spot over the next few years.
Help us understand, a lot of folks come to Yahoo Finance, they know us for stocks, the Magnificent Seven, you name it. How does what you do right now in the private markets impact equity holders?
The largest issuers of equity in the world, the largest by market cap weightings in the world, generally have been underrepresented in the credit markets, certainly the public credit markets. Take the Mag 7 I think the highest one is Oracle in terms of how much of an issuer is in IG. Most of them are 100 to 200th largest issuers.
And Oracle's just getting started based on that backlog.
Just getting started. These companies over the next 2 or 3 years are going to be the biggest components of the investment grade market as well. Way faster change even than what we've seen in equities. It is driving everything. It's driving the economies, private and public. And so I think really paying attention to this dynamic, this is where it's at. IG is where it's at, and we're really happy to be at the center of it.
I heard Apollo CEO Marc Rowan at the Goldman conference this morning talking about the expansion of data centers, how these companies building data centers need more financing. What does that mean to private credit? That Mag 7, like we're talking about, all these companies building data centers, trying to support the future of AI. How does that change the complexion of private markets?
We are looking at very large shifts in terms of large financing needs across Europe and US. Data centers is one of them, defense spending, energy transition. And for us, that is a public and private story, but actually mostly a private credit lending story. It's long dated. These are very long dated cash flow needs. And for us, as a large retirement services driven business with very long dated liabilities, it suits us really, really well. And so that's the really big takeaway for us, is we're really excited about the next few years as being a much more of a buyer's market for that kind of long dated spread that's going to be driving the European and US economies.
We're seeing a lot of these companies take out, this is significant debt. And it's been a while since this country has seen this type of investment in these data centers, for example. How does that change? Is there concern rising in the market that there is too much debt being taken out?
Well, most of these companies have very little net debt relative to their EBITDA. They're just getting started. They've mostly been spending their cash flow on this. They're just starting to become asset heavier businesses, so they're entering the debt markets. A good example, Meta tripled the amount of IG debt outstanding in 1 month in September. The entire outstanding amount of debt tripled in a month. So you're just getting started in terms of issuance, and it'll last many years. We think, in terms of how much spending has to happen for this CapEx cycle, just related to AI, let alone other needs that are happening in the economy.
What are people still getting wrong about private markets?
I think that there is still an association with sub-investment grade. So when people talk about private credit, they're mostly referring to the sub-investment grade market. Still a big market. We're involved in that market. I think it's grown a lot over the last few years, and so that's why it's top of mind. But really, it's grown also with the public markets pulling back. So public 2022 and 2023 issuance and high yield and leveraged loans was down a lot. It happened to grow in private. But for us, we've been spending time on private IG since the 10, 15 years ago, since we really started to get involved in the retirement services business. But that market also way predates us. The banks have been doing this for decades. So it's really the driver of the broader economy. It's very diversified. It's generally secured. It's long dated. It's really a very different asset class. So just thinking about private credit as a commodity is not the takeaway. You have to actually get into the weeds of what are you actually talking about. And for us, 38 of the 40 trillion is a private IG opportunity.
We, I mentioned at the top of the show, we saw Tricolor. We saw people concerned about what was happening with companies like that, just lower quality. How come that didn't spill over into the equity markets? We saw maybe a little pressure here and there, but we didn't get that spillover event that I think people were worried about.
Yeah, at this stage in the economic cycle, you are seeing credit defaults happening, but they're not outsized. Even if you look at projections for next year, most banks are calling for 2% defaults in high yield, maybe 3% at the upper end for leveraged loans. And if you look at the indices and the public indices, even though spreads are very tight, they're actually really, I would say, the breakup makes a lot of sense. 3% of the underlying indices trades at 1,000 basis points or higher, and the rest of the market trades really tight. High yield is mostly at a 150 to 250 spread, except for those 5% of issuers trading at 1,000 plus. So the market's really efficient in saying these are businesses and business models that we think have to restructure. It's pricing it already that way. And of course, you're going to look at individual names when they do restructure as saying there's maybe something more to it. But the reality is the broader economy is really strong. Torsten's going to be on today talking about it.
I can't wait to see Torsten.
He's,
I hope he comes armed with 15 charts for me.
I think he's going to have more, maybe more than 15.
Is investment grade right now still investment grade?
Sure, yeah. I mean, not only is it rated investment grade, so that's by the actual little definition, but you're talking about secured, low LTV, highly collateralized, first lien lending that's happening in very diversified formats. So it's a big market, but it's growing. Even at a 2 or 3% GDP growth, you're talking about a huge need for very safe lending, very low historical default rates, practically zero if you look at the history of Apollo and Athene. So it's still very much IG, and it's actually growing because of, again, those big needs for, think about the big needs are also backed by governments or investment grade companies. These are the highest quality issuers of debt in the long run for the next few years, so it's really exciting.
Let's say we do get, one more rate cut early next year after this one. How do you see that impacting markets more broadly next year?
I mean, the rate curve has been steepening. So I think you're seeing, yes, we have reasons there. Torsten's talking about the K economy, and many out there are doing that. So there are reasons to cut rates, maybe near term, because you're kind of seeing that differentiation. But long term, rates have been pretty sticky. And so I think a steeper curve is going to bring in more opportunity for, again, long dated financing. It might bring more leverage into the system. That's not our ball game. Our ball game is issuing long dated liabilities and investing in long term assets. So I think that for us, when an asset leaves the banking system and comes into our world, it becomes safer because we're not funding it with near-term deposits. But I think that's kind of something you want to pay attention to, is where's the leverage in the system going.
And of course, you're not just making bets for next year. I mean, these are long-term bets that Apollo's making. Like, how could one go about making money over the next decade from some of the trends you've talked about?
These are the biggest issuance opportunities in the world that we've seen in credit, certainly in my lifetime. And so I think, again, you're becoming from a seller's market to a buyer's market. That probably means spreads will be eking wider. We've probably seen a floor of credit spreads, but it'll be combined with a lot of issuance. And so I think high quality. It doesn't get better than being able to buy a lot of good stuff at wider spreads, which is the opposite really of what the market's had to look at the last few years. We've succeeded in finding plenty of things to invest in. We're largely IG focused, but I think that the opportunity to invest at wider spread levels in good credits has just begun.
Lastly, John, has there been something that has surprised you in markets this year?
I think the entry of AI into credit, it's really the story of 2025 in credit is the year that AI entered credit. And I think it's going to be here for a while, and I think that's just a new thing to think about. It touches a lot of different asset classes that we participate in, and we're spending a lot of time thinking about it.
Do you see the companies that have issued a lot of debt this year to support, let's say, data centers or their compute power, whatever it is, you think we'll have more in terms of dollar value next year? Is this just the tip of the iceberg that what we've seen this year?
Tip of the iceberg.
Wow.
It's just beginning, and it's happening in a lot of different asset classes. So it's not a commodity, like everything, it's not a commodity. Knowing your contracts, knowing your counterparties, having good underwriting. We have 4,000 plus originators doing this every day. We've got hundreds of investment team members that are going through all these asset classes. You need to have that to do this at scale, to have that breadth of origination, to ultimately invest in good portfolios. And it's going to be about who does that best over the next few years.
Carefully building your portfolio is crucial to growing your wealth over time, and the traditional 60-40 portfolio isn't the winning formula it once was. Here with more is Stephanie Drescher, Apollo Global Management Chief Client and Product Management, Portfolio Management and Trading. Good to see you, Stephanie, and I totally bungled her name. Look, this is live TV, is what we're doing. Apollo Global Management Chief Client and Product Development Officer. Good to see you.
Good to see you, Brian. Thanks for having me.
Just had a fascinating chat with John Cortese on how interest rates are impacting private markets. Like, what's your vibe on that? How do you see it impacting what you do?
Yeah. So look, the client interaction is phenomenal, kind of through their advisors, and they see Apollo as a firm who has navigated market cycles, interest rate cycles over decades now. And importantly, when we think about interest rates and the interest rate environment, we do anticipate that interest rates will likely be higher for longer, which could create a headwind for the 60-40 portfolio. And we certainly saw that in 2022. And when we couple that with the concentration that exists now in the stock market, S&P 500, the ups and the downs really correlated, as we know, to kind of 7 companies at the end of the day. So the need for private market exposure as a piece of the fixed income portfolio and the equity portfolio is really critical to make sure that our clients and ultimately their portfolios benefit in many ways, which we can go into, that as the institutions have seen over decades now. So we do expect an environment where interest rates will likely be higher for longer, and that proves to be beneficial to the inclusion of private markets in an overall 60-40 portfolio.
Does that concentration risk in the S&P 500, does that worry you?
So, look, we've seen not only on the ups, but even on, in the first quarter of the year, how 95% of the decline in the S&P 500 was in fact based on those 7 companies. So the idea of replacing a percentage of an otherwise kind of public equity portfolio with more diversification, we believe provides that excess return per unit of risk. When we look actually at all companies globally, 90% are in fact private. Yet it's still kind of a very small percentage, certainly of individuals that have that exposure in their portfolios. So And in our view, in order to create the diversification that the individuals and families deserve, you need kind of both levers, both the public and the private in a portfolio. And to your point, when you step back and look at the total size of public companies out there today, it's actually half of what it used to be. So I think times have changed, and it's a moment for our advisor community, the financial community, to recognize and question, are things in fact different today than they used to be?
Every day, or it seems like every day, Stephanie, I see a new tech company raising money at a valuation that frankly blows my mind. And then you drill down to the company, they're not making any money today, tomorrow, or probably the next year. What's your sense of the valuations we're seeing right now in private companies?
Look, our philosophy as a firm is purchase price matters. That's just who we
I've
are.
heard that so many years from Marc, and it's a good line. It's
You
good.
know what? We stick to it. So, over many cycles and decades now, as a firm, we've seen valuation cycles, and we maintain our discipline, because at the end of the day, that underwriting process, the consistency, the rigor, that's what our clients trust us to do. And we're aligned with them. So our own capital are in the strategies that we manage on behalf of our investors. And that's super important, because we can't guarantee the outcome, but we can guarantee a shared outcome. And they trust in that over cycles.
Is it hard to stay disciplined when you see this fear of missing out, or FOMO, and it's out there and it's alive in the markets?
So, you know what, when I think about the firm and our investment committee process, there's such a discipline that runs through how we source our assets on a highly proprietary basis, how we originate, how we review the diligence, and we just keep that focus. So frankly, we don't see that in our investment decision making. We want to make sure that our entry point and the price, ultimately, that we're creating a portfolio ultimately delivers the risk return that we believe is appropriate for the asset and for our clients.
Are the valuations we are seeing in private markets, are they frothy?
We find our way in terms of navigating the market, and we've deployed a very meaningful amount of capital. So, as a firm, we look to originate ultimately assets that we're comfortable with in terms of entry point and purchase price. And we tend to kind of not generalize in terms of the market, because we pick our spots.
If 60-40 is no longer the playbook, what is the ideal way for someone out there to build a portfolio?
So as we speak to advisors on behalf of their clients, it's giving them more tools in their toolkit as they think about what their client is trying to plan for. What do they need to save for retirement? What wealth do they want to build? And therefore, when we look at the overall portfolio, we can then determine what liquidity they need, or illiquidity they can accept. And there's a whole range now of structures that give more choice, ultimately, to the advisor and to the clients that they serve, in order to use both public and private solutions in the portfolio. And what we're seeing already is that private market building blocks are not only selected on an individual kind of strategy by strategy basis, but more frequently now, we're starting to speak to advisors about how a portfolio of private markets can complement what they have in the portfolio, or how private markets can be a key part of a model, or a more holistic discretionary pool of capital. So there's so many use cases, but at the end of the day, it's looking at the fixed income portion and the equity portion of a portfolio, not as simply public options, but looking at alternatives to those public stocks and bonds.
When you're talking to advisors ahead of next year, is there a strategy you're really honing in on that you're communicating that you're like, all right, we like this, we recommend that you do this?
So we have a range of solutions because the private market range of offerings that we can deliver to our clients is everything from private investment grade all the way through to the more traditional private equity structures. I would say, just to give one example of many that we speak to the advisors and clients about, is, for example, asset-backed finance, an area that the community is looking more and more closely at as a part of their overall portfolio allocation. A really great complement to what others have known for some time in terms of direct origination. And asset-backed finance is about a $20 trillion market out of a $40 trillion credit market, and it provides the ultimate financing to the real economy in the markets that we invest in and serve. And so as we look at the underlying portfolio construct, often investment grade in nature, the inclusion in that portfolio includes aircraft leases or different types of fleet finance, music royalties, et cetera. And the stability of that return profile can be a great addition to an overall portfolio. And we've built that capability now over 15 years by creating operating companies and platforms that have an incremental kind of 4,000 employees to originate on a proprietary basis. And that's real alpha for clients as part of their portfolio. So it's definitely a range of strategies, but that's one example.
Lastly, before I let you go, Stephanie, has there been one thing that has surprised you in markets this year? This has been a wild year. I mean, there's so many big moments.
Who would have imagined a lot of what we saw, right? Especially in the first half of the year. But as I think through certainly how we've navigated it with our clients and in the portfolios, I feel like the transparency of information, the active communication, if anything, it's provided an opportunity to make sure that we're that much more connected to our community of partners around the world. So it's times like this that strengthen relationships.
Yeah, it has been a crazy year indeed. Stephanie Drescher, good to see you. Happy holidays.
Great to see
Thanks
you,
so much
Brian.
for joining us. We appreciate it.
Thanks for having me.
This is Fed Day in America. Fed cut rates by 25 basis points. How does this impact what you do in your business?
In reality, 25 basis points doesn't really move things one way or the other. Directionally, right, we've seen rates starting to slide down a little bit, but realistically, we're not going back to the days of 0% risk-free rate. So in the grand scheme of things, there's a cost of capital, that's required for borrowings, for, factoring into valuation. So doesn't really change things all that much.
You're going to take me back to my spreadsheet crunching days there. Look, we had one dissenter at this Fed meeting who wanted, I think it was Stephen Meyer, who wanted a 50 basis point rate cut. The companies you touch and see, the executives you talk to, is the economy in a place that would warrant a 50 basis point cut?
I do feel for the Fed governors here who have to make these decisions because we are getting mixed economic data, right? On the one hand, we're seeing unemployment, creeping up. On the other hand, inflation stays stronger than I think people would anticipate. The U.S. economy has been shockingly strong for the last several years, right? I mean, we saw almost 500 basis points of rate moves, couldn't really slow the economy down. We've had some other actions out of this administration that on paper should have slowed the economy down, but has not really slowed the economy down. So it's really trying to land an aircraft carrier in the middle of the ocean land the airplane on an aircraft
totally
carrier.
Easy.
So it's hard to really know. I think we probably don't need a whole lot more rate cuts. We'll put it that way. The economy is still chugging along pretty soundly. And if I were in charge, I'd say let's pause for a little bit and see.
The job's open.
Yeah, exactly.
The job is open. So, talk to us about deal making. I think the Fed signaled one more rate cut for next year. Whatever it is, they are cut rates by 175 basis points now. What does it mean for deal making?
Yeah, look, it's actually been a pretty good environment for deal making. Over the last couple of years. You got to separate, what's in the inventory of private equity, portfolios and new deals. That 18 to 22 timeframe when rates were, like I said, essentially 0% cost of capital, you had a lot of great companies purchased by the private equity industry, but at pretty lofty valuations. And so private equity inventories are pretty full right now. For the last couple of years, it's been more difficult for the typical private equity firm to sell assets because that rate move has changed the valuation environment. And so you have portfolios full of good companies, but bought at the wrong price. I think as rates start to creep down a little bit, that will allow a little bit more companies out of inventory, if you will. I also think the passage of time helps. Companies can grow into these loftier valuations that folks were hoping for. Fortunately, at Apollo, I like to joke we never got the memo that the cycle was going to last for 15 years. Mm-hmm. So we stayed true to our value orientation, and that's allowed us to actually be exiting even in this environment. And so, like for example, we've had 4 IPOs since Liberation Day. We've continued to sell assets, and feel pretty good about that. As far as new deals go, no, it's a pretty good time to be buying stuff.
What sectors you think? What attracts you right now?
For us, we are opportunistic investors. We look for where there's interesting value, and so notwithstanding the S&P sort of hitting new records every couple of weeks, it really is concentrated in a handful of names. If you look back at sort of the S&P up 25% last year, teens this year, that performance is not spread evenly. You have 10 stocks that were up, 50+% last year, and I think the average company in the S&P was up 6%. A third of the S&P was down last year, right? So you have a lot of interesting companies, industrials and consumer financial services that have not really seen the type of performance that the headline S&P numbers have shown.
Exits have picked up, which is, I imagine, good for your industry. Is next year the year of the big exit? You see that momentum continuing?
Yeah, I think it will continue. I don't think it's going to be a whopper of a year or materially better, but every year that passes where a recession doesn't come, you have companies that are just continuing to grow, accrete into those valuations I was referring to earlier, and that allows sponsors to sell a little bit more out of their portfolio. So I think it's the passage of time more than anything else, unless we believe we're going back to a zero rate environment, which I don't think. Then I think you'll see marginally better, but rates are still going to be 3.5%. They're not going back to zero.
What is the secret sauce on knowing when to exit? What do you look for specifically? How do you know the environment is right to sell a portfolio company?
Yeah, for us, it's because so much of our investments are based on like an investment thesis. We're buying a company that needs a transformation, that is trying to get from point A to point B. We're typically looking to exit when we've, mission accomplished. We've achieved, the big lift that we're trying to achieve. The beauty of private equity is you don't have to be market timers. You don't have to get the timing perfect if you've paid a reasonable valuation on the way in and you've created a lot of good things along the way. And so it's less about the perfect timing, although when the perfect market conditions exist, it may not be according to your schedule, and so sometimes you have to lean in and just say, you got to make hay when the sun is shining.
Lastly, you've been at Apollo since, 1996?
Correct.
How is the private equity industry, how's it changed? Like, what's the biggest change you have seen?
Yeah, well, obviously the scale. When I started 30 years ago, private equity was a cottage industry. It was, maybe it represented 0.5% of GDP. Today it's, I've seen stats somewhere between 10 and 15% of GDP is private equity owned companies. And so it's just a much bigger part of the whole ecosystem. Obviously, the scale in which you can do transactions. The beauty of Apollo is, though, the secret sauce that made us great, 30 years ago is what holds true today. Find good companies, pay a reasonable price for them, operate them well, and be thoughtful about when you exit.
There's a growing crisis in this country, and it has to do with the fact that we're all getting older. Me included, I can't even believe it. The rapidly growing population plus a growing savings gap has sparked an urgent demand for guaranteed lifetime income. One tool to help close that gap are annuities. And here with me to go through the benefits of annuities is Mike Downing, Athene co-president. Mike, good to see you here. The stats around retirement they are absolutely mind-blowing. 40% expected increase in the number of people aged 65 and over in the next 25 years. Set the stage for us. How does that impact a business like Athene?
So from a business standpoint, it's just incredibly large demand for annuities today because of the growing retirement population. And it's inevitability. Everybody's getting older, the population's getting older, and not only are they getting older, they're living longer. And one of the challenges of traditional defined contribution savings is retirees or people planning for retirement running out of money. And that's where annuities can really come in and save the day, is help close the gap and actually create spending confidence at retirement.
As I look at your business, you mentioned people scared about running out of money. Is that one of the biggest fears they have right now when you talk to retirees?
It is, and it's a real fear. It's well over half fear running out of money. It's about 64%. And it's a real fear because most savers have enough, just enough. And a market downturn could mean they don't have just enough. And to give you a sense as to the power of annuities in terms of just a punchline, if you have $1 million nest egg, if you integrate that nest egg with annuities, that $1 million can feel like $1.5 million from a spending standpoint. So think about that in terms of spending power. So that's how annuities can come in and translate from nervous retirement to confident retirement, surviving versus thriving.
What mistakes do you still see retirees make?
Twofold. One is underspending, and so that's a fear of running out of money. And that's where annuities can really close the gap, is they can guarantee that lifetime income to the extent the actual assets run out. That's what insurance companies do, guarantee it. And the second is not early enough purchasing of annuities. Big benefit annuities is tax deferral. Tax deferral is a young person's game, not an old person's game.
Why? How can you get young people to get excited about retirement planning? When I talk to 25-year-olds, retirement planning, I'm never going to get old.
So one of the great things about annuities, it makes it simple. Right, there's lots of different flavors. You can get a simple product that's just a guaranteed rate times a term. Think of it as like a CD, but instead of a CD, it's earning about 200 basis points more every year. Super simple, super easy to do. Second there's types of products that guarantee principal, but you still get equity upside, so you can still participate in the market, but guaranteed downside protection. But largely, it's peace of mind. So if you don't want to think about retirement, annuities can really help you get peace of mind and help deliver your retirement for you.
You talk to a lot of people. Do you get the sense sub-30-year-olds are planning well for their retirement, better than my generation? I'm an aging millennial.
Yeah, I would say it's a mix. And one of the things we're starting to see a younger group of buyers starting to buy annuities, and that's positive, but it needs to continue to go lower just to take advantage of that tax deferral.
There's, it's not lost on any of us. Today is Fed decision day in America. The Fed is likely to cut interest rates by 25 basis points, maybe follow up with one more early next year. Whatever the case is, what will lower rates mean to the retirement industry?
So people still have to save, right? And the rate environment is more or less where do you put your money? And so regardless of rates, annuities are still a very valuable option because ultimately they'll still outperform CDs. They'll outperform CDs in any market. They will provide guaranteed downside protection in any market as opposed to the S&P. And so we see demand continuing to grow simply because of the growing aging population. And we've already seen it today. Rates are well off their peak highs. Demand is still incredibly strong for annuities.
Rates lower for longer. Do you think people are going to have to take more risk? Are they going to be forced into taking more risk if they want to earn returns? It's been easy the past 2 years. Dump your money in CD, earn 3 or 4%, make a good return, call it a day.
Yeah, I would say rates lower for longer. There's a temptation to take more risk. And again, that's where a really smart integrated annuity strategy. Think of, again, a typical saver that's going to get to about $1 million. 30 to 40% of that, put that in a nice basket of annuities, completely protects you from low rate risk as well as volatility risk.
We saw, this year, President Trump sign an executive order for that could allow 401ks to invest in private equity. Is that the next big catalyst for this industry?
So 401ks is clearly, so by background, I'm a pension actuary. I watched the DB industry decline.
And I've talked to you before, like you are the man in this industry.
Yeah.
You're the man.
Watched it decline for 30 years. So what is DC? It's a $12.5 trillion pot of retirement money with no protection. It needs annuities inside of it. And the second thing it needs is differentiated returns. Right now, the way the DC market works, it's migrated to just all index funds, nothing uncorrelated with the S&P. So adding annuities, adding a sliver of private assets will help return and stabilize returns.
What has surprised you about markets this year?
Biggest surprise in markets this year has really been, in terms of 2025, is what we're seeing is the message that we've been giving out for a little while now, which is taking advantage of the tax deferral of annuities, is larger group of younger buyers deciding to look at annuities and buying annuities.
How will, you looking out over the next, you've been doing this for decades. I'm not calling you old. This is what you...
Seasoned.
This is what you do. How will retirement look different in 25 years?
I think the way it'll look in 25 years is I think you will cease to see distinction between DC, accumulation, and spending, and really see a complete integration between annuity, income protection, and defined contribution accumulation.
You help us understand, for those that are investors in Apollo, how does that relationship work with Apollo and Athene?
It's a powerful relationship, right? So what Apollo brings to the table is incredible investing skill. So as an insurance company, we need safe yield. So all of our assets need to be investment grade. We need to maintain our AM Best A+ rating. So we need that safe yield. Because of Apollo's massive origination machine, they can generate safe yield, and often take out the middleman. And that extra yield, that little bit of extra yield, can be passed on to the customer. And it allows Athene to be able to offer, for comparative companies, 25 to 50 basis points more in return.
There have been headwinds to this industry, and I think the company, y'all just give a presentation a couple weeks on this. You said, I believe, that the headwinds for this industry are lessening. What have been those headwinds?
The headwinds historically for annuities is they've been a forgotten corner of the market, right? So the higher rate environment kind of popped and reawakened the market, and what we're seeing today is an acknowledgement of the value that annuities provide. Annuities today aren't the annuities of 30 years ago, and that's why we continue to see the high demand despite the decline in rates.
Why are annuities better than a CD?
Well, simple math is, if you have a CD, CDs typically roll over about 20 years. Would you rather earn 2% or 4%? On average, it's 2% more every year on a annuity versus a CD. So think about that. You're saving for 20 years. You can earn, with the same amount of savings, 1.5 times as much money. To translate in that retirement gap, the total CD and money market's about 10 trillion. A lot of that just rolls to retirement. Let's assume that's just 20%. That's 2 trillion. Put that in annuities, that 2 trillion becomes 3 trillion of savings. That's $1 trillion closure of the retirement gap, which is 4 trillion today.
Lastly, Mike, the term retirement crisis gets tossed around a lot. Do you believe this country is in a retirement crisis, and how would you define something like that?
I would say it's in a spending crisis. There is a retirement crisis. There's a $4 trillion gap, and a lot of that gap is a result of the fact that there's savings that are accumulated that haven't been reprogrammed for spending. And that's where insurance can come in. That's the value that insurance and annuities can bring, is they can increase that savings that exist and make your 1 million portfolio feel like a $1.5 million portfolio from a spending standpoint.
One more. Why are you so passionate about this industry?
So I've watched.
Where did that even come from?
So I've watched the decline of pensions, right? The decline of lifetime guaranteed income protection. And we have an opportunity to fix it. It's a really once-in-a-lifetime opportunity for the insurance industry to come together and close the gap. It's capital. We have the capital. We can provide the guarantees. And a company like Athene has $35 billion of capital to really make a big dent.
Well, good to see you again.
Good to see you,
happy
Brian.
holidays. Michael Downing, Athene co-president. Good to see you. We'll talk to you soon.
Good to see you, Brian.